Interest rate swaps are derivative contracts in which two parties agree to exchange interest payment obligations based on a specified notional principal amount. The most common form is the fixed for floating swap, where one party pays a fixed interest rate while the other pays a floating rate linked to a benchmark such as LIBOR or SOFR. The notional principal itself is not exchanged. Instead, only the net interest payment differences are settled periodically. Interest rate swaps are widely used by corporations, banks, and financial institutions to manage exposure to changing interest rates. The program emphasizes swap mechanics because swaps are central instruments in modern fixed income and risk management markets. The primary purpose of interest rate swaps is to transform the nature of borrowing or investment exposures without refinancing underlying obligations. A borrower with floating rate debt may enter into a swap to achieve fixed rate exposure and reduce uncertainty regarding future financing costs. Conversely, an institution with fixed rate liabilities may swap into floating rate payments if it expects declining interest rates. Swaps are often motivated by comparative advantages in borrowing markets, allowing counterparties to reduce financing costs through mutually beneficial arrangements. Financial intermediaries, particularly swap dealers and banks, frequently facilitate these agreements by matching counterparties and managing residual exposures within broader derivatives portfolios and trading operations. The mechanics of an interest rate swap involve periodic cash flow exchanges based on agreed terms. At the start of the contract, counterparties determine the notional amount, payment frequency, maturity, and reference interest rates. The fixed rate payer makes payments calculated using the agreed fixed coupon, while the floating rate payer makes payments based on periodically reset benchmark rates. On each settlement date, only the net difference between the two obligations is exchanged, reducing transaction costs and settlement risk. Interest rate swaps can range from short-term agreements to contracts extending over many years, making them flexible instruments for managing long-term financing and investment exposures. The valuation of interest rate swaps depends on the present value of expected future cash flows from both fixed and floating payment streams. At initiation, swaps are generally structured so that the present value of fixed payments equals the present value of expected floating payments, resulting in a net value of zero. As market interest rates change over time, the value of the swap fluctuates because one side of the agreement becomes more favorable. Valuation requires discounting future cash flows using appropriate spot rates or yield curves. Changes in benchmark interest rates, credit spreads, and yield curve shapes all influence swap valuations and associated market risk exposures. Interest rate swaps expose participants to several important risks. Market risk arises because changing interest rates alter the value of future cash flows. Counterparty credit risk is significant in over-the-counter swaps because one party may default before fulfilling contractual obligations. Liquidity risk may emerge if a participant cannot unwind or offset swap positions efficiently. Operational and legal risks are also important because swaps involve complex contractual documentation and settlement procedures. To mitigate these exposures, regulators increasingly require central clearing, margin requirements, and standardized reporting for many swap transactions. Effective swap risk management is therefore essential for maintaining financial stability and institutional solvency. Beyond traditional interest rate swaps, many other forms of swaps exist to address specialized financial risks. Currency swaps involve exchanging both interest payments and principal amounts denominated in different currencies, allowing firms to manage foreign exchange exposure and access international funding markets. Equity swaps enable parties to exchange returns on equity indices or stocks for fixed or floating interest payments. Commodity swaps allow producers and consumers to hedge against fluctuations in commodity prices such as oil, natural gas, or metals. Credit default swaps transfer credit risk from one party to another and became particularly significant during the global financial crisis because of their widespread use in credit markets. Cross-currency swaps are especially important for multinational corporations and global financial institutions. In these arrangements, counterparties exchange principal and interest payments in different currencies, often enabling borrowers to obtain more favorable financing conditions abroad. Currency swaps help manage exchange rate risk while diversifying funding sources across international capital markets. Commodity swaps are similarly valuable for firms exposed to volatile raw material prices, such as airlines hedging fuel costs or mining companies stabilizing revenues. These swap structures illustrate the flexibility of derivative markets in tailoring financial risk management solutions to highly specific corporate and institutional exposures. The program highlights swaps as essential derivative instruments for managing interest rate, currency, commodity, and credit risks in global financial markets. Swaps provide flexibility, cost efficiency, and customization that are often unavailable through standardized exchange-traded derivatives. However, swaps also introduce substantial market, liquidity, operational, and counterparty risks that require sophisticated valuation and risk management techniques. Understanding swap mechanics, pricing principles, cash flow structures, and risk exposures is therefore critical for financial professionals responsible for portfolio management, treasury operations, and derivatives oversight. As financial markets continue to evolve, swaps remain among the most important tools for managing complex financial risks and optimizing capital structures.